All right, hi guys. Welcome to the second InvestBright educational module. Today, we're going to go over inflation, why you should invest, some important vocabulary, company sectors, assets versus liabilities, and how you can follow news about stocks.
So let's start with the first topic of inflation and why you should invest. We can start by discovering what is inflation. So in simple words, inflation is the increase in prices of items and goods over time, and it's a decrease in the purchasing power of money. So money's value goes down over time. Let's look at an example. Many years ago, Coca-Cola would have costed about 10 cents, and today you can get the same Coca-Cola for say $2. This means that there's an increase in the price of Coca-Cola over the many year period, and there's a decrease in the purchasing power of money. So 10 cents is worth a lot less today than it would have been many years ago. Let's check it out how it plays in the US. A small amount of inflation is always good in economies or in countries. US sees about 2% inflation every year. In fact, this year COVID-19 caused some extra inflation of about 6% because of, some supply and demand issues, but prices increased because of reduced supply in some items like used cars and created an overall inflation method. Now, from our previous example, you would see that a coffee cup would cost about 25 cents in, say, 1970 and cost 150 cents in 2019. This means that, the 25 cents can only buy one cup of coffee in 1970, but it can barely buy a cup of coffee in 2019. So the money's purchasing power has reduced. Maybe if you can buy a Nintendo Switch for $300 today, maybe for a similar product in the near future, you'll have to buy it for $600 because of inflation. If you have $100 lying around, then your money's value is going to decrease in the long run, like I mentioned. The $100 in cash that you have today would not be worth $100 10 years later. As I mentioned, the $300 that you used to buy a Nintendo Switch might not be able to buy you a Nintendo Switch X number of years later. So it's not really worth the $300 later than it is today. As you can see in this image, $5 could buy you maybe three burgers back in the day, but now they can only buy you one burger. So that means the purchasing power of money has reduced. You can buy less stuff for the same amount of money, and before you could buy more stuff for the same amount of money. So you keep your $100 in your bank account or in your pocket money in your wallet. That's not going to be able to keep up with inflation. If you have a wallet and $100 cash note lying around in it, it's not going to be worth $100 10 years in the future. Similarly, if you put it in your savings account, a savings account is a place where you deposit some money and it offers you some interest or some return. That means if you put in $100 in a saving account, then maybe after 1 year, you'll have $102. Or not $102, maybe after 2 years, you'll have $102. But we want to have $102 after 1 year, but the bank account doesn't simply provide enough interest to do that. So to avoid this money's value from decreasing, we have one option, which is to invest it in the stock market. Let's talk about long-term investing and why you should invest young. So as you can see over here in this graph, it shows the value of the US stock market in the long run. And you can see that it has grown 584%. This means that if you invested $1 in the stock market in July 24th, 1981, it would be about $35.84 today. So understanding about so investing young helps you sort of hedge or reduce the risk of inflation and keep your money at the same value as and even increase it maybe. So understanding about investing young means that you can learn from your mistakes and you can invest better as an adult. Right now, as you're investing young, you won't be investing hundreds of thousands of dollars. You'll start with a small amount. And as you invest a small amount, you're going to learn mistakes, you're going to learn about the process of investing, so that when you actually invest thousands of dollars as an adult, you can invest better and make more money. And the value of your investments are going to increase by the time you're adult. So as you see over here, the value of the stock market has just increased over time. The earlier you get in, the better it is. So if you put in $100 every month starting from today in a safe investment, that's going to be worth a lot by the time you grow up. So this is a quick summary of why what happens in economies like inflation and why you should invest.
Next thing we're going to go over is some important vocabulary, mainly portfolios, dividends, and ETFs. Firstly, a portfolio is just a collection of all the stocks that you're invested in. Generally, we represent it with a pie chart and they have a weightage of investment. This means you say what percent of your money is in what stocks. So investing in Jay's lemonade stand, his newspaper business, and his dog sitting business, that might make up your portfolio, if you remember our example from last week. If you invest a third of your money in each of them, then your pie chart should be divided into threes with all of his different businesses. Next thing we'll talk about is dividends. Dividends is just money given periodically to investors of a company from the profit that the company makes. Why do they exist? So companies pay dividends from their profits as a reward to investors for investing in their companies and helping them grow. Now, generally, some companies like Tesla, it's a super attractive buy, but they don't offer dividends. So are dividends really something super attractive and something you should go for? Stocks that give good and regular dividends are attractive in the long term, not for the short term. Because if a company is giving out dividends, then you know that it is very stable and they have a lot of surplus cash left over to give to investors. So if Jay gives $10 to his friend, his uncle, and his dad every month who invested in his cart, like we saw last time, he's giving them a dividend of $10 for their shares. So this is an example stock portfolio with ticker symbols, and this is something you might see in an investment bank's report. You might even have one of these charts for yourself, right, to display your own portfolio. And each stock also has a ticker symbol, just telling you, what it is in short form, because you don't want to read the whole name all the time, right? The next thing is stock indices. So a stock index or stock market index, kind of like the S&P 500 or the Russell 2000, is an indicator of the prices of the companies in the stock market or a part of the stock market. So for example, the NASDAQ mainly tracks tech stocks. It is a tech index. It helps us, and these indices help us identify the overall stock price of the companies in the index or area that are going up and down. And generally, when someone says the stock market is going up, the stock market is going down, or the stock market has tanked, they're referring to the graph of the index. That has many companies in it. So you can say the entire stock market has moved a certain direction. So one good example of an index is the S&P 500 index. And this just contains the 500 largest US companies. And this graph shows from before 1991 to 2021 how much growth it has had. It's been almost 3,000%, but the S&P 500 has been been in play for way longer than 1991. So what are ETFs? This is another term you hear very commonly in financial news. An ETF, or an exchange traded fund, is an investment fund which is also traded on the stock exchange, almost like a company. Investing in these indexes gives people exposure to a wide variety of companies. So if you take, maybe you've heard of Cathie Wood, she's a very legendary investor, and she trades in a lot of tech stocks, and her ETFs are full of very different growth stocks that are meant to show just promise in future industries. So her ETFs might have Tesla, Roku, and very other highly valued growth companies in them. Unlike other funds, it's bought and sold daily for different prices. And while stock exchanges will always have stock indices, not all indices are stock exchanges.
So, yeah, in summary, what you learned is that a portfolio is just a collection of stocks. Dividends are a regular payment given to shareholders or investors. An ETF is a single measurement of a collection of stocks and their stock prices over time. and we saw we saw ETFs that track indexes. Now let's go over company sectors and market cap. So company sectors are basically classifications of companies, and they were developed by Standard and Poor's LLC in 1999. If you remember S&P 500, that actually stands for Standard and Poor's 500 companies. So we can classify company into these different sectors right here. Um, you can see several different sectors like energy, materials, industrials, consumer discretionary, consumer staples, healthcare, and financials, information technology, telecommunication services, etc. So why this is important is that when you invest, you want to make sure you have good exposure to a good amount of industries. As we mentioned in the last video, you want to have some diversification. For example, in 2000s, a lot of tech companies or information technology companies, their stocks crashed or their stock prices fell very steadily. So if you knew about different sectors like maybe financials or energy, and you had though your money invested in those sectors as well, you might have not lost as much money as you would have if you just invested in the information technology sector. This is a standard concept of diversification, but the concept of sectors helps us classify companies in different areas for us to invest in. Some examples include companies in financials or financial services can include investment banks like Goldman Sachs. Companies in information technology sector could include companies like Facebook, Google, and an example of consumer discretionary sector is Tesla. Let's look at industries versus sectors now. So the sectors that you just saw are very broad general classifications, and they're used quite often in economics. Now, industries refers to a specific group of companies that are in these sectors. For example, I gave the example of financial services. You have many different financial services industries like, fintech, which is finance and tech, insurance, brokerages. A brokerage is a company from where you can buy stocks, banks, investment banks. So these are different industries, and in these industries, you have companies. For example, in insurance, you can have AIG or American Insurance Group. In brokerages, you could have companies like Robinhood or TD Ameritrade. In banks, you could have investment banks like Goldman Sachs or commercial banks like Bank of America. Another important concept to classify companies is market cap. You guys remembered that market cap is the value of a company, and it's derived by multiplying the number of shares or outstanding shares multiplied by the stock price of each share. So over here, we classify companies by market cap in three ways. We have large cap companies, medium cap companies, and small cap companies. Another word for cap is capitalization. Cap is just the abbreviation of that. So any company which has a value or a market capitalization of more than 10 billion is considered to be a large cap company. Any company that has an investment value between or that has a market cap value between 2 billion and 10 billion is considered a medium cap company. And any company that has a market cap value which is less than $2 billion is a small cap company. Here you see some common examples. For example, Amazon handles all your daily delivery logistics. Nvidia is a very big tech company that produces a lot of cool tech stuff. Virgin Galactic is Richard Branson's space tourism company. Groupon is an online service that helps you find discounts. So this is how we classify some companies using sectors, industries, and market caps, in short.
Next, we'll go over assets, liabilities, and the different assets classes that exist among securities. Securities just means stocks and different things that you can hold. So, very simply, assets will always make you money more often than not, and liabilities will always take your money. So, assets can include stocks, they can include bonds, and many more. Liabilities, however, can include accounts that you need to pay, interest, taxes, any bills that you may have. any loans that you've taken out, or debt. Simply put, it's money that you owe to someone else and you need to pay it off. Now, companies will often list their assets and liabilities in their financial reports, and we can use them to make some calculations and find out more about how the company is doing. So, for example, companies in their liabilities will always include their debt, and they'll also include their equity in their financial statements. And we can calculate debt to equity ratio, which will teach us some stuff. Next thing we need to know is asset classes. The main asset classes that exist are stocks, bonds, money, property, and commodities. Each asset class has its own benefits. So, for example, some people they'll hold cash to minimize risk in the case of a market decline, and commodities such as gold and silver are often viewed as hedges against inflation. Bonds are stable and they'll offer a yearly return to investors, while real estate is highly opportunistic and a very speculative asset class. So each asset class has its own advantages and disadvantages in terms of risk and return.
Adding on to Shantanu's mention on asset classes, the different asset classes are associated with different levels of risk. For example, the stock market is pretty volatile or it goes up and down a lot. You can see the chart of one stock in a day and you will see many up and down movements. And you are potentially vulnerable or you're potentially exposed to several events like stock market crashes, which are very risky when you put your money in the stock market. So that's why with this asset class, the higher risk you have, the higher return you can expect. You can expect to make $1. You can expect to have a 3,000% return for what you invested, like we saw in the previous chart. Bonds, for example, have low risk and they're relatively stable investments. Cash is as well low risk as well. Commodities are high risk and um, they provide often high returns as well. Now, let's look at some stock market awareness and news sources so that you can get started on being more aware of what's going on in the stock market as you start grasping the and the basic concepts. So, here are some common sources we have outlined for you. We advise you that you need to work with your parents before you start discovering stocks and do not invest in any stocks if you don't understand them. We don't provide financial advice and we wouldn't be liable in any way. Please read a complete statement on our website under our terms and conditions. So, for example, over here, you can see that TD Ameritrade and Stock Rover are stock screeners. News outlets are Morning Brew and Market Watch. I read Morning Brew every morning, and it gives me a good update of what happened in the markets the previous day and what are some big events happening in the stock market. And then you have some dedicated stock platforms like, Webull and Robinhood, which provide a lot of information on stocks at a higher level, of course. But yeah, and let's go over what's a stock screener now. So it's a tool that allows an investor to basically sort through stocks and ETFs according to some criteria. For example, if you know a lot about stocks, you might have heard of this number called the PE ratio. For those of you who don't know what that is, that's basically a measure of how expensive a stock is. If you go to a stock screener and you say you want a stock with a high PE ratio, then it's going to filter out stocks and it's going to give you some recommendations. This software is free and built in brokerages as well, and it's usually useful for all types of traders, institutional or individual investors. As a quick note, institutional investors are companies or large business entities that invest their money, while individual investors or retail investors are investors like you and me who invest our own small amount of money in the stock market. Finviz and TradingView are some common stock screeners, and we definitely recommend that you don't rely on stock screeners for all your stock picks and do some fundamental analysis and research as well, which we will cover upon later.
So, in short, what we covered today is that inflation is a devaluing of a currency due to an increased amount of circulation. Time in the market always beats timing the market, and long term investing is the safest way to invest. Remember, if you start early, you'll definitely get higher returns than if you started late. A portfolio is a collection of different assets. Now, this doesn't have to be limited to just stocks. You can have bonds, you can have gold, You can have even crypto if you want, but all of it will balance out, and you want to create the best performing portfolio that you can. Next, dividends are just payments made by the company over time to its investors, and we use sectors and industries to classify different companies. Lastly, we went over the fact that stocks, they can be found in many different ways, but your best bet is to use the news and stock screeners to find them. Now, when you actually analyze them, you want to look at financial statements and stuff. You don't want to rely too heavily on screeners and news just to analyze them. And we'll go over how you can analyze different companies in future lessons. Thanks for watching.